Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/Rive to receive the top 10 stocks to buy right now. A down stock market means there's a lot more deals out there for investors, so we wanted to highlight a few companies that we think are just too cheap to pass up right now. And joining me to discuss that is John Quast. John, how are you doing, and what is your first stock for us today?
Hey, Travis, thanks for having me. And I'm glad to be here because I do want to talk about Zoom Video Communications, symbol ZM. I know that you've heard about it as a consumer. You've probably used its video conferencing software. However, what you may not realize is that recently Zoom has become primarily an enterprise solution, not a consumer level solution. So what does that mean? A vast majority of Zoom's revenue now coming from enterprise customers, and these customers tend to sign long-term deals, and so we can actually track this under remaining performance obligations for Zoom. So Zoom's revenue up by a single-digit percentage in the most recent quarter. However, its remaining performance obligations up 31% year over year to a record $3.2 billion. Now, another interesting thing about Zoom's revenue, people all talking about how Zoom's growth is slowing, but one of the interesting things that is happening is the revenue is being recognized over a longer period of time. So last year at this time, 67% of its remaining obligations was going to come in less than a year. Okay, so roughly 2/3 of the remaining performance obligations in 12 months or less. Now it is 59% of revenue, so almost half of the revenue being recognized over the next year. So going from 2/3 to a half, what this is saying is it's signing longer contracts with its customers. And so maybe you're not seeing that revenue growth right now, but the RPO is up 31%, and most of that is being pushed back towards the into these longer deals. And so I think that really bodes well for the stability of Zoom as a core business. They do have a lot of ancillary products that they're trying to launch. They have time to do that. Trading at 5 times sales, its cheapest valuation since it's been a public company. I think that you look at Zoom here.
Question for you on Zoom. Does this mean that individual customers, so people that have been paying $10 a month, $20 a month for access to Zoom just because it was convenient to have been canceling their subscriptions, but companies have been increasing their subscriptions or maybe increasing the capabilities that they're having in that subscription? Is that the right way to think about it?
That's absolutely what's happening. And so they can actually break that out in their financials. The consumer segment, like you and me, that is actually down. It is not up. It is not slowing growth. It is actually declining. So people like you and me are canceling their Zoom accounts because we need it less and less. However, the companies are finding it more indispensable. And so that is actually a higher growth rate. It's over 20%, the enterprise revenue growth rate. And so when you look at the single-digit growth rate for the entire company, you start to say, wow, as this whole consumer decline headwind, as that starts to go down, you're going to see that revenue growth rate go up, in my opinion.
Yeah, that's one that I think the future might be a little bit brighter than the market thinks right now. The one that I wanted to bring up is Target. So this is one that has been beaten up over the last couple of quarters, primarily because they made inventory decisions that turned out to be incorrect. You think about, and I want to talk about the challenge before we get to the value piece. The challenge for a company like Target is they plan their inventory and what they're going to hold in stock about a year in advance, 6 months to a year in advance, because they have to make orders with companies that are going to produce those products. They got to create signage. They got to do all kinds of things. It isn't like an Amazon that just, you or I put something up on the Amazon store and it's available tomorrow and off we go. So when they make a mistake coming out of a pandemic where they assume that maybe people are going to continue buying a whole bunch of outdoor furniture, and it turns out they weren't buying outdoor furniture because they were going back to work, that really creates inventory challenges. And that's what we saw in the second quarter, the third quarter, and we'll potentially see in the fourth quarter as well. That has been a hit to the company's bottom line because they've had to discount products to basically move them through the supply chain. But these are temporary problems for a company that I think is still doing extremely well. So let's talk about why I think this is a great value. So I have the price to sales chart here of Amazon and Target. Amazon trades for 1.8 times sales. Target trades for 0.7 times sales. Not necessarily a perfect comparison, but you can see that there is at least better value in Target than there is in Amazon just based on that metric. Price to earnings. Even despite 2 poor quarters, Target's price to earnings ratio is 21. Amazon's is 82. So we're getting a better valuation there. But when I look at long-term, where is Target going? I really like what they're doing with Drive Up specifically. I live in the same city that Target's headquarters is, so we see kind of some of the things that are going to be rolled out nationwide, maybe before other regions. I mean, our local Target, I can order things before going to I can order groceries before going to drop my kids off at daycare, swing by Target, never get out of the car, have those groceries put in my trunk and drive home. That is incredibly convenient. Only a company that has Target's products and physical locations is going to be able to do that. I mean, that's something that Amazon can't compete with, or at least isn't competing with their Whole Foods acquisition. So I think they're really well positioned now. Before the current downturn in earnings, their net income was nearly $7 billion. Their market cap right now is just over $70 billion. So just some quick back of the envelope math. The stock is trading at about 10 times what I think is normalized earnings. That's an incredible valuation as long as earnings come back up. And we see that what I keep watching with them is, are the revenue numbers coming down? Are things reversing from the high growth that they had during the pandemic? And the answer is no. In fact, they're continuing to grow. They're taking market share. So I think that's great trends for Target, great value. And if you're willing to buy and hold long-term, great stock to own. Any thoughts there, John, before you go on to your next one?
I love it, and I really think that you're right on. Target is one of those value stocks that I've looked at myself as well, because I do think, to your point, they're reasonably valued now, and their earnings are under duress.
Yep.
So even under duress earnings, I think it's a reasonable price at which you are paying. And if you assume that this is a one-time problem, that it does bounce back to where it should be, that normalized, like you say, this is a phenomenal, sensational value at this price right now.
Yeah. And what do you have next for us, John?
Well, next I have Match Group, symbol MTCH. This is the company, online dating services, many platforms, including the Tinder platform. So I just want to this is a simple little pitch here that I'm going to make as far as the too cheap to pass up, trading at its lowest price to sales valuation as a public company, but in one of the worst performers of the S&P 500 in 2022. Thinking about it, I want to contextualize this with the context that this is a platform that has enjoyed incredible adoption over the years. When you think about Match, the whole Match portfolio of brands, and specifically Tinder over the last 5-6 years, very, very incredible as far as adoption goes, and incredible as far as profitability goes too. This is a company with just outstanding margins historically. Now you bring in the situation where a lot of stuff is going on with the company, more than what we can discuss here, but it is why it has been an underperformer in 2022. That is a situation ripe for new management. A historically good product needs a new set of hands holding onto the steering wheel, and they're getting that here in Bernard Kim. I believe that I'm saying that correctly. And so this was the previous CEO of Zynga. And some of the things that I like about Kim, as far as what he has articulated as Match Group's new CEO, is that Match has historically acquired a lot of different platforms and then let them operate as is, which is good in a way. However, he said that the lines of communication were not open between platforms. And so this platform is learning this valuable insight here, but it's not getting shared throughout the rest of the company. That is changing under Kim. So the lines of communication being thrown wide open. We need to learn from each other's mistakes. We need to build on each other's successes. I love that as a new, just outsider perspective coming in and saying this has got to change now. The other thing changing under Kim, and something that he was very good at Zynga, was finding new ways to monetize the business. And so you look at what Zynga did over his tenure, going from just, however they were generating revenue to more in-app purchases, all sorts of things. Going to bring that kind of perspective from Zynga to Match Group. trading at a low valuation historically, and kind of similar to Target, it's trading at a reasonable valuation on kind of depressed financial metrics right now. I believe that turns around here in the near term, and I think that Kim really better manages this company over the next 3 to 5 years. And so it's one that I think is a good, probably too cheap to pass up today.
One of the things I've always found interesting about Match, I mean, it's great that it's a two-sided market, a dating market where, the more people you have on the platform, the better it is. But if you're successful in matching people, you lose customers. So I think that's just one of the ironic things about Match as a business, is that their success is actually in the product that they're making is actually terrible for their financials. But that has not proven to be bad for the business long term, because there is always a next generation.
And that's the thing, right?
Yeah,
there's
exactly.
more fish in the sea, which I think is actually a Match property.
Yeah, I was gonna say. All right, the stock I wanted to end on is Topgolf Callaway. This is the worst ticker change in market history, from Eli, who was Callaway's founder, to MODG. It was apparently Modern Golf. They're trying to change what golf is. Anyways, golf is available. Just take golf. Topgolf Callaway was started with the Callaway brand, so Callaway clubs, clothing products. There's a number of other brands underneath that. But then they merged with Topgolf, which is essentially a 50-50 merger, more or less, and now they're about 50-50 as far as the size of the businesses go. But I think the trend here that I really like is going out and doing stuff and having entertainment be an experience, and not just going out to eat, not just going and sitting at a movie theater, but doing things like going to a golf location where I can have a beer and some food and hang out with people. Maybe that's their family, maybe it's coworkers. It just gives a ton of optionality to keep that place busy all day. And the economics of each Topgolf location are just incredible. I believe it's 50% cash on cash returns. So they actually don't own the real estate, but there is money that they have to put into building out the business. But they're generating 50% return on that investment in the first year that those properties are open. That's just incredible from an economic perspective. I don't see this fundamentally being disrupted. I just see it growing long term. And I see a lot of options for improving and expanding the product. We've seen them kind of playing around with using the fundamental technology that they use for tracking golf balls to move into football and baseball. And, there's all kinds of other sports. There's also augmented reality. I mean, I could see a day where you go into Topgolf and now I put some AR glasses on and I can play a game that is just augmented, on the physical world. I mean, there's really interesting and compelling things there, and they have the technology, they have the group to be able to build those things. So I love where the business is at right now. $200 million in net income over the last year. They're still kind of crawling out of the pandemic, so I think that number will get better. Trading at about 20 times earnings. So I think that the tailwinds are just behind this entire segment. And, it's going to be choppy. It's going to be up and down. But for investors who can just buy and hold, I think this is going to be a great investment long term. And if you've been to a Topgolf, you'll see that, I mean, the amount of money that's spent there, particularly by corporate customers, is just insane. And I think that's going to continue as people are working at home more, looking for ways to not only go out with their friends and family, but also, I mean, if you've got a company and you only see your coworkers once or twice a month, Topgolf is the kind of place you take them. So I think that's going to be a great business. All right, the 4 stocks that we have for you today that we think are too cheap to pass up are Zoom, Target, Match, and Topgolf Callaway. Thank you to John Quast for joining me. And be sure to subscribe to Rive Investing and give this video a like. Leave some comments in the comment section below. Let us know what you think and your ideas for what stocks are too cheap right now. We will see you here next time.